So in a way, having established the importance of the technological change for the climate transition as well as its relative increase, a very straightforward question to ask from a finance perspective is the investor reaction, or what is the relationship between market valuation and financial performance and this climate efforts by companies. Because ex ante, this relationship could go in either direction. On the one hand, the climate technologies represent a kind of a option to an opportunity to in a transition economy. So firms and investors investing in this climate options can expect to have higher realized cash returns in a transition economy. On the other hand, many of the climate technologies are still at an early stage. The data show that they tend to be more novel and complex compared to other innovation and non-green patents, for example. And innovation itself is a firm level innovation, at least, is a hard to process and uncertain source of information for many investors. And previous empirical studies that have looked into innovation have usually concluded that innovation tends to be misvalued in stock markets. So we can expect this relationship to go in either direction. And additionally, one specific thing about climate patents is that at least for large firms, they are usually issued by firms in energy sector and by oil and gas and transportation firms, which tend to have higher carbon emissions and which are usually shunned or avoided by some responsible funds. So this again adds a more complexity to this relationship that we are looking at. And previous studies, in a way in line with these expectations, have found mixed results as well, with some papers showing a positive relationship between some measure of market valuation or financial performance and climate patents, as well as a negative or non-significant relationship. And in this paper, our goal is not for now as so ambitious as to bridge the gap between these two literatures, but what we are trying to do is to benefit from the granularity of patent data and have an exploratory look at the relationship between different types of climate patents and market valuation. And as an overview of our results, we find or establish no relationship between overall climate patents and Tobin's Q, which is our proxy for market valuation. However, we find two instances in the data where climate innovation seems to matter for market valuation. The first is when climate innovation is conducted in a carbon-intensive technology, such as internal combustion engines, and contribute to their efficiency. And so in theory also contribute to improving their emission profile. A second subset of patents in our data that seems to be correlated with market valuation are those that contribute to both adaptation and mitigation goals at the same time. Overall, again, our approach remains quite exploratory, but we try to interpret these results through some descriptive analysis and suggest that the result that we are seeing could be the case of investors valuing short-term innovation responses to climate change as kind of a less risky solution to the climate change risk. So we measure the innovation based on patent data, as you may have already guessed from the introduction. The patent data is a publicly available and a rich source of data which is third-party verified in the sense that the patent issuing agency has to issue the patent to the company based on a criteria of original contribution. But what makes patent data advantageous as well is that it comes with a lot of information on the type of technology that the companies are innovating in. So here we have information on the text of the patent, but also many classification codes which make it easy for non-experts like us to classify and understand the types of technologies that the patents belong to. For example, in our paper, we rely on the international patent classification codes to identify patents in carbon-intensive technologies. which is so defined as those that are in either fossil fuel electricity generation or fossil fuel based transportation. And second, for the climate technologies, since they are more of an emerging field and they can span different existing technological fields and contribute and be found in many different other fields, we have another tagging system called Y02 developed by European Patenting Office to help identify these patents in a more easy manner. So in the paper, we rely both on this main IPC codes and Y02 codes to define different types of climate innovations, basically in 3 stages. And we get more granular in our definitions as we move through the steps. So the first, we are only looking at the difference between climate patents and non-climate patents. So we assume that a given patent is climate if it has a Y02 tag, and if it doesn't, we consider it as non-climate. So the purpose for this is to, in a way, position our results with the rest of the studies that have been done on this topic. So, and again, even starting from the first stage, what we are looking at is the difference between is the relative valuation of each category in the stock markets. As a second stage, we add the carbon-intensive dimension, and our interest here is the intersection of climate patents and carbon-intensive technologies, since these are, in a way, in a gray area where technologies contribute to climate change because they can lead to, in theory, reduced emissions, but also they contribute to the carbon-intensive and polluting mature technologies. So as we can see in this table, what we do to come up with categories is first look again in this climate dimension and see if a given patent has a climate tag. And then the second, we look at the IPC codes of the patent and see if a given patent is in a carbon intensive field or if it's not. So in that way, we end up with these 4 innovation categories that are mutually exclusive. And finally, we focus on the climate non-carbon intensive patents, which in a way combine all the other patents that are in climate, but not in climate, not in carbon intensive. And we distinguish it further based on whether they contribute adaptation or mitigation goals. We think that is an interesting distinction because they represent, in a way, a solution to 2 different types of climate risk. So their respective valuation could be interesting to see. So just to illustrate, for example, in this slide, we have a picture of a solar panel, which we can consider as a non-carbon intensive climate patent. While on the other hand, we have a scheme for heat pumps that shows some relative emission reductions, and as such can be considered as climate carbon intensive in innovation. Our model is very simple. We rely on a paper by Hall and his co-authors, which provides a market valuation framework for innovation and R&D expenses. So it's hedonistic regression, and the assumption is to look at the market valuation to determine valuation for these intangible stocks. These intangible knowledge stocks, as we call them, are constructed based on R&D expenses and patent filings of the companies. And of course, in our paper, we are interested in different types of innovations. So we are considering constructing patent stocks for each category individually. And these categories change again depending on which part of the empirical framework we are in. For the data, we rely on US patents for now, and it comes from PatentsView. We use KPSS dataset, so it's a dataset written by Kogan and his co-authors, to merge that to stock price and accounting information data. And we look at firms that are innovating and that have active R&D expenses. So in terms of the summary statistics, we can see that around 7% of our patents are in climate, and within climate patents, we have around 7% that are carbon intensive. in terms of the adaptation and mitigation breakdown, we have far more mitigation patterns than adaptation patterns, which makes sense given the relative attention the mitigation patterns, mitigation in general has received compared to adaptation. Okay, in terms of the industries that are innovating in climate, as I already mentioned, I think in my introduction, that the industries that are going to be most affected by this innovation are those also that are innovating more. So now I can quickly go to my result table, since I have 5 minutes. So in the first table, we regress these binary categories on market valuation. And in the first 3 columns, we are regressing the knowledge stocks on the current year of Tabin's-Q. So our cutoff year to construct the patent stocks is the same as the market valuation that we calculate for the company, but we can also look at 1 year forward, and it's not reported in the table, but we also look at a few year forward Tabin's-Q as well as kind of a robustness check for the results, and they don't change much. So what we see in this table basically is a non-significant coefficient for climate patents, which we can interpret as markets not valuing overall climate innovation. But since we see a non-significant coefficient for non-climate patents as well, we can argue that this non-valuation could be the case of overall innovation being not valued, either because it's too risky or the patent data are kind of populated by many low-quality patents with little applicability. So our question is then if we can find some types of climate innovation and innovations that are valued. And with that aim, we look at, again, at the carbon-intensive dimension. And here we see that among the 4 categories, climate carbon innovation patents are those that are positively associated with market valuation. And our interpretation is that this could be the case of investors valuing more applicable inventions, since these patents are about improving the efficiency of existing technologies as opposed to climate non-carbon intensive, which is more about the reinventing the wheel and innovating in more novel technologies. And it's also interesting to observe that in a similar group of carbon-intensive technologies, those with the climate tech has a positive valuation, again suggesting that in specific instances, investors may be valuing the climate application or impact of the innovation. And finally, since we don't see a positive impact on climate non-carbon intensive patents, which is the largest and general group of climate patents, we want to see whether differentiating between patents that contribute to adaptation and mitigation can reveal some differences, which we don't find in this table. But interestingly, we find that patents that contribute to both at the same time have some positive correlation with market value, suggesting either these patents could be more applicable or maybe investors have a more additive approach to the way they value climate inventions. So this is a final test where we want to see whether our interpretation or explanation for the types of innovations that are valued by markets is true, which is that whether these innovations are more applicable. And to do that, we rely on one descriptive test based on citation patterns. And basically, in this graph, we are looking at the number of citations that patents in a given category have received, divided by total number of citations that they have received. So if we see a taller hand side, this suggests that the patents are cited faster. And interestingly, we see that the patents that are in climate carbon intensive, which is the category that we have seen to be positively valued, are those that are cited faster compared to the other categories in our sample. And when we apply that to adaptation and mitigation breakdown, interestingly, we find a similar pattern for patents that contribute to both adaptation and mitigation, which were also the ones that were positively associated with market value in our regression. So with that, I can wrap it up. Basically, in the paper, we, of course, argue the interesting data that the foreign patents provide to track their innovation efforts. And we also highlight its importance in climate finance. And we indeed applied that to climate innovation patents and find some instances where climate innovation is valued by markets. And our descriptive evidence suggests that this could be investors usually valuing short-term and less riskier solutions to the climate change transition risk. And as such, of course, we may need more research to determine that, but also a recommendation could be to have public solutions where the riskiness of climate inventions are considered for private investors. So thank you very much.
Thank you very much, Murad. Thanks a lot. So now we welcome Hélène Mathurin from ESSEC Business School for the last presentation.
Sorry in advance for my broken voice, recovering from the flu. So last presentation before the coffee break. Let's go. I'm going to present you a project called Pricing of Green Regulatory and Technological Risk, which is a solo paper, which is my job market paper. So the initial idea of the paper was to try to look at the interaction between the different dimensions of climate risk. And in particular, I'm going to focus on the two main dimensions identified in the literature of climate transition risk, which are regulatory risk and technological risk. So just to give a definition, carbon-intensive firms are going to be more exposed to restriction taxes from environmental policies, and so that creates a regulatory risk. So the investor can demand higher expected returns to compensate for potential penalties or operational constraints. On the other side, less innovative firms, and here I'm talking specifically about innovative in the green space, less innovative firms are going to be to benefit less from green subsidies. They are going to maybe lag in adopting green technologies, and they are more susceptible to displacement by greener competitors. So that's what we call the technological risk. In order to, as I mentioned, I want to study more the interaction between those two risks. So in order to do that, the main particularity of my approach compared to the literature is that I'm going to estimate first the risk premia associated with each of those risks, but I'm going to look at them dynamically in the time series to identify some interaction. And then I'm going to provide some explanation to what I observe, in particular related to decisions of environmental policies, by considering the two main instruments of environmental policies, which are, so here you have two examples. One is all the legal restrictions taxes. You have the example of the carbon border adjustment mechanism in Europe on the left, and the other one are the subsidies, green subsidies, with the example of the Inflation Reduction Act in the US at the same period. So, to summarize my contribution and findings in this project, the first one is empirical and the second one theoretical. So first, I'm going to build some new monthly firm-level measures of exposure to both regulatory risk and technological risk by using textual analysis on press releases. So the main novelty here is the use of press releases compared to the literature that tend to use conference earnings calls. But conference earning calls gives quarterly measures that you can eventually smooth to have something monthly. But with press releases, first there are spontaneous communications from firms, so they should be more informative, and they are timelier because they are produced continuously. So I will have some real monthly measures of exposure for firms. So the associated risk premia are going to give me two new empirical facts. The first one is that I observe a significant negative correlation between the time series of risk premia, those two time series of risk premia. And the second one is the existence of two regimes that you could say low regulation and high regulation. So to be more precise, under a high regulation period, that would be when you have a Democrat president. My study is on the US, so yeah. When you have a Democrat president, well, the excess return in equity prices associated with regulatory risk will be positive, while at the same time, the risk premium associated with the technological risk will be negative, which here you will see the way I compute my exposure will mean that innovative firms will have actually a lower cost of equity. And under the low regulation regime, then the sign of the two risk premia change. So the implication of this result, there are several. The first one is that, in the literature there is mixed evidence on the sign of this regulatory risk premium, but they usually look only at the average. So here what I show is that there are actually changes of sign over time, which could explain that when you only look at the average, depending on the period you consider in your study, you could find a different sign. The second thing I show is that the sign is really related to the political party in power, so it also shows that environmental policies, when they are enforced, are actually creating the right financial incentive to encourage the transition to a low carbon economy. And finally, more from a corporate finance maybe point of view, what we could say is that it shows that brown firms maybe have incentive to invest in green technology in order to stabilize the volatility of their cost of equity over time. So my second contribution, which is theoretical, will be a new model to actually explain the empirical facts that I observe. And I will show that it mostly explains those two empirical facts by changes in the probability of green regulation. So I will be quick on this, the next 3 slides that are related to the creation of the measures, because I just, in the interest of time, you can have the details in the paper. So it's a database of nearly 9 million press releases for US firms from 2009 to mid-2023. I make the standard assumption in this textual analysis literature that the more mentions you have in the document, in the press release about green regulations, the more exposed the firm is to this regulatory risk. And on the opposite, the more mentions of green technologies, the more involved is the firm in green technologies, but then it means it has a lower exposure to the regulatory risk, technological risk, sorry. So in terms of the way I construct the measure, I rely on the machine learning algorithm of King, Lam, and Roberts to give me a score for each press release to give to what extent it is related to either green regulations or green technologies. And then the firm exposure will be the average of the scores of each press releases for a given month. I will also be quick regarding the series of validation tests I do to make sure what I'm capturing with my measures. So in particular, as is current in this literature, I check that there is a positive significant relation between the exposure, the regulatory exposure measure, and firm's carbon intensity. And on the other side, there is also a positive significant relation between the technological exposure I measure and the firm's green patent share. I also check which firms, which industries are in the top 5, with the highest measure for regulatory or technological risk. Similar to the literature, I found that there are also, often the same industries in actually both top 5. But on the other side, when you check the correlation between the two measures for a given firm, there is no correlation. I'm not capturing the same information with the two measures, even in the highest decile of the measures. So now let me spend some time on this graph, which is kind of the key result here. So I estimate the two time series of risk premia associated with my exposure measure using two-step Fama-Macbeth regressions, using the exposure measure as firm characteristics, of course with a bunch of control variables, and they are also, yes, estimated simultaneously. So here on orange, I hope you have the color right, you have the excess return associated with the exposure to regulatory risk, and in blue you have the one for the technological risk. As you can see, I have also defined some zones. So the blue zones correspond to a Democrat president in the US, and the red zone to red zones, well, there is only one, to a Republican Democrat, Republican president. So in particular, you will see that the first blue period corresponds to the 2 mandates of Obama, followed by the first mandate of Trump, and at the end, you have most of Biden's mandate. I also mentioned at the top, which party dominates in each chamber of the Congress. That's important to see the level of support from the Congress to the US president, with the same color code in blue for Democrat and red for Republican. So what can we see if we look first at each time series separately? Let me first talk about the overage, because as I mentioned in the literature, that's what they usually look at. So on average, the regulatory risk premium is significantly positive, around 1%, which is consistent with the literature. And the technological risk premium is significantly negative, around minus 1.5%, which is also consistent with the literature, although there is less literature on that fact, but you have in particular the working paper of Leibold and you. Now, if we look at the time series, what do you see? During Obama's mandate, the regulatory premium in orange is mostly positive, although there are, of course, some variations. Then, during Trump mandates, it oscillates, but it reaches its lower level during the second half of Trump mandates. And then, right at the time of Biden's election, it goes back to positive. Now, if we look at the technological risk premium, it's quite low during both Obama's mandate, except for an increase at the time of Obama's re-election. And then, as soon as you have a Trump election, the technological premium becomes positive and reaches its highest level during the first half of Trump's mandate. And right, again, around the time of Biden's election, it decreases a lot before becoming negative around a year later. So I'm kind of going to formalize what we observe here by 2 simple tests. Here, about the negative correlation, sorry, I didn't mention it, you can see that not all the time, but often the 2 time series of risk premia tend to move at the same time in opposite directions. So that's what I check here by looking at the cross correlation, so between the innovations and an IR1 process fitted on each time series. And I have indeed a negative correlation around minus 53%. Sorry to come back here, I forgot to say something. What I'm showing here is not the raw time series of risk premium that I estimate, because it's quite noisy. It's the trend based on an STL decomposition with a period of 12 months, to have it more like just visually nice. But I do also my econometric test on the raw time series, and the results are there. And the second empirical result, so I regress each time series of risk premium on a dummy equal to 1 when the president is Democrat. And what you can see, all the coefficients are significant. And we see that the regulatory premium tends to be negative, but almost 0 under Republican presidents, and 1.5% higher under Democrats, which means that under Democrats, carbon-intensive firms will have a higher cost of equity. On the other side, for the technological premium, it's around 2.5% on average under Republicans, and more than 4% lower under Democrats presidents. So it becomes negative. Again, that's what we could expect under Democrats because of the green subsidies and so on. Innovative firms will have a lower cost of equity. So now, my idea here was also to have a model to explain what we observe empirically. So let me start, okay, 5 minutes, perfect. Let me explain first with a graph before going to the equations to give you just the idea of the mechanisms. So it's a consumption-based asset pricing model. So at the top you have consumption growth, delta C, it should be delta C, sorry, which is driven by two long-run persistent components, one driven by brown activities, brown production, and the other one by green production. And I'm going to represent the green regulations and green innovations using two separate jump processes, JR and JI, and so you have also the intensity processes associated with the jumps, which are lambda R, lambda I, which represent approximately the probability of green regulation or the probability of green breakthrough innovation happening. So what are the key assumptions I make? You can see with the different colored arrows. So with the brown one shows that that's brown economic growth that is going to increase the probability of a regulation, so creates the need for a green regulation. That's the same. That's a short way to represent physical risk and all the climate change process, and that's the same used in the paper of Giglio and co-authors in the RFS paper of 2021. More importantly, here the most important mechanism are the two green arrows. I make the assumptions that when you have a green regulation, it has two effects on the economy. One is a negative impact on brown economic growth by, the political instrument that I mentioned, the policy instrument that are the legal restrictions, the taxes. And it has a second effect, which is positive, which is an increase of the probability of innovation. So it stimulates green innovations with the second policy instruments that are the green subsidies. The final row is actually quite intuitive. It says that when you have a breakthrough green innovation, it increases green growth. So the corresponding equations. So I don't think I will have time to comment, and it's just the same thing, the same mechanism I just presented with the drawing. And when I solve the model, I find the following equation, let's say, for the regulatory premium and the technological premium. And as you can see, they are both linear combination of two state variables that are lambda R, the probability of a green regulation, and lambda I, the probability of a green innovation. And in particular, if you look at the lambda R, the coefficient in front of them, one is it's positive for the regulatory premium and negative for the technological premium, which is enough to explain the two empirical facts. When you go from a Republican president to a Democrat president, you will have an increase of the probability of regulation, an increase of lambda R, perceived by the investors. So it means that the regulatory premium is going to increase and the technological premium going to decrease because of the sign of the coefficient in front of them. So that creates a negative correlation. And then for a given lambda I stable, let's say, if the lambda R increased to some extent, then the regulatory premium, even if initially it was negative, because it increases, it's going to become positive, and the technological premium, because it decreases, it becomes negative, which is what I observe empirically. Regulatory premium, which is positive under Democrats, and the technological premium, which is negative. So yes, the model managed to explain the empirical finding, mostly by this assumption you know that green regulation have a double effect on the economy. The negative effect on brown economic growth, which increases the regulatory risk premium, and the positive effect on the probability of innovation, which in turn increases the chance of a positive shock in green economic growth, which decreases the risk for innovative firms. Let me just wrap up. So I have built new firm-level measures of exposure to both technological risk and regulatory risk by using textual analysis on press releases. Then looking at the associated with premia, with those measures, I find a strong negative correlation between the time series of the two risk premia, and changes of sign that suggest that it's related to the political party in power. And I propose a theoretical model to explain those empirical observations. Thank you.
Thank you very much, Hélène. Now we are welcoming Mathieu Jubrel for the discussion.
Okay, thank you. So we're a bit late, so I need to be done by 5, right? Yeah. Take a few minutes, probably skip the beginning so that you can actually go get a coffee break. So continue a few seconds to make the most of my infographics, because I'm going to switch directly to what I thought of the paper, since we all have them in mind. So first of all, I really like the approach. I think I'll be able to talk about more or less both at the same time, because the topic is quite similar: innovation in climate solutions and how they are valued by the markets, what are their consequences on the financial performance and metrics of companies. So it's quite interesting to see how the different approach responded to each other. So first of all, the first one, focusing on the climate patents, has been able to go deeper into the details of the topics that were actually fostered by the patents and the innovation. So that's a real good point, I think, even though, of course, some simplification had to be made, and I'm going to get into more details later on this. The point of the second paper that the first didn't have is, of course, trying to get an idea of the external factors, other external factors that could influence the valuation and impact of innovation and patents on the companies through mostly the regulation and the political context in the US. So I think they're quite complementary, and as an idea for future research, of course, trying to cross the two approaches would be a great idea, obviously. Regarding the criticism that I think we can make on this paper, just like Gunther, not in any specific order. I think for the first one, market valuation on climate patents, well, first of all, there's quite a short-term focus, I think, and probably you've been looking at longer-term focus and maybe didn't get much results, but the financial effects of innovation and patents are measured using the current year and 1 year forward Tobin skew, so for the influence on valuation. While many green innovation may have some longer-term benefits, so I think maybe it's a lack of data or lack of results in the analysis that have been performed, but that would be really interesting to try and get a longer view, because 1 year doesn't seem much for climate-related innovation. Also, the fact that the proxy used to assess the innovation is the patent count. So it's, of course, a first proxy that we can have, but many patents can be low quality or just incremental based on innovation that has already been performed by the company. So there's no real assessment of how much of a breakthrough each innovation brings about, and maybe it can also have an effect. So tiering these different patents can definitely make sense. The way they have been classified, of course, as I said, there had to be made some assumptions. So here there have been codes and tags used to classify them in climate and non-climate. as well as thresholds put to classify them as carbon intensive and non-carbon intensive. So that's a first grid that we can use to read the topics of the different patents. But as I said, I think that would be really interesting to try and figure out which one are actually bringing new innovation, new avenues for industrial processes or whatever, compared to those that are just incremental and being used to just secure some intellectual property by the companies and that do not bring that much innovation. And also, as many papers that are based on regressions, some endogeneity concerns. For instance, the fact that higher firm valuation may lead to more innovation and hence more patents, rather than patents leading to more profitable firms, or at least firms that are perceived as being more profitable. So of course that's an effect that we'll try to isolate, but yeah, it's be really interesting to figure out whether it's one way or the other or both. And I think the second paper with press releases, it has been stressed already, there are more point in time, so easier to isolate and to figure out which one is causing the other, or at least to make assumptions on this. So here there might be some endogeneity concerns. And of course, an observed factor that could affect both patenting behaviors and firm valuation based on R&D quality, management ability, strategy of the company in general, that are perceived well or not by the market. So that's the main points that I had for the first paper, the first article. Regarding the second one, so really interesting as well, and I think regarding these topics on innovation, there are some issues or avenues for improvement that are quite similar, and based on the fact that trying to assess innovation is trying to assess something that's qualitative, and so turning it into quantitative is always a challenge. So here we had in the first paper how the patents are classified. Here it's about how text analysis is being used. So the data set ranges from 2009 to 2023, I think. And so just over this time period, I think the words we use have evolved, regulation have evolved. There are new words that were not regulated at the time that are now. Just taking some recent examples, the way we consider defense has been changing over the past few months. A few years and months ago, people were talking about ESG all around. Now we're not talking that much about ESG. It's more about sustainability, because in the US they don't want to hear about ESG. And that's just a few examples of a few last months, and now we're talking about 15 years. So using the same models, I'm not specialist enough to say if it's a good idea or not, but I think it should be justified to use the same models over all this time period. Also, the words that have been targeted specifically, they've been manually chosen. So makes sense if there's no actual database and consensus on what kind of words we can look for in the patents. But maybe it's also an obstacle for the to expand the results to other studies. And more specifically, I like to point out, and maybe that's a justified choice as well, but the model is only targeted bigrams, so sets of 2 words in patents, not monograms, because they could be used in other contexts, and not longer n-grams, because they would be too numerous and too hard to, I don't know, list or assess. But that's also something that's probably debatable, and that's a technical choice that has been made, but probably that led to overlooking some topics. So once again, transforming qualitative into quantitative, I think there are a lot of choices made here that could be questions. Also, the fact of using the political regime as a proxy, so I really like that, and it's really easy to read in the US, obviously, with Republicans against Democrats. So to take a broader view, I'd like to figure out how this could be applied to other regions. So maybe I'm thinking about the EU, and all the countries that would have more than 2 parties there. So yeah, is it because of the US? And also the fact that there are not that many switches, obviously, between Democrats and Republicans. So there was, the main charts that we had, where we saw Trump between Obama and Biden, and well, of course, we did see the lines cross, but is it enough figure out whether it's actually due to this political divide in the US or a number of other metrics and macroeconomics and political biases that we have around. Yeah, maybe beyond political, could get into more details. So the models, then the theoretical models bring this with regulation that has an influence on innovation, on the risk of brown firms. But yeah, I think the headline maybe could be more made more specific and try to find more hypotheses regarding the specific rules and set investors' behavior that could explain why under Trump specifically, that here represents all the Republicans, but under Trump in the end, we had these results. Just well, for instance, would it have happened with other Republicans? Yeah, who knows? We're not going to be set anytime soon since it's Trump again. But yeah, I think yeah, I would have liked to get more insight into the details why behind this investors change their behavior. And regarding measurements also of the noise, the regression, so you used 3 regressors, naive Bayes, random forest, and SVM, and used the average of the 3 to get the final results with, so it assumes basically equal reliability across models, which is not justified. So maybe having some reflection around the specificities of the different models and a justification on why they're equally valid to probably avoid outliers would also have been a good idea. And the systematic regarding the metric that's used for risk scores. Finally, it's going to be I think yeah, no, I have two more comments. So regarding the risk score, the way they are built. The frequency of big rounds is turned pretty much directly into a risk score. So that's pretty much as with the number of patents. I think should be justified methodologically to actually build up the score, or more justified. And yeah, it's a bit maybe a simplistic mapping to go from frequency to risk. And it may fail to account for quantitative differences on how risks are discussed and taken into account by investors. And last thing I'd like to bring up is also the press releases. So here it was a study in the US, so that's probably quite homogeneous. Everybody's talking English, more or less. So that might not be a big concern right there, but there has been other work, of course. I think that the selection process of press releases can introduce biases, especially when they're in different languages. I'm thinking about papers, for instance, by Christophe Révelli, looking at controversies in Kazakhstan. Of course, not many people speak Kazakh, and especially not ChatGPT. So it has been way less covered, or not as well as equivalent English-speaking news. So here, not that much of a concern. We're talking about the US, but there might always be a bias in press releases, the selection of this data and the way it's being computed by models. So yeah, I don't know to what extent you've been measuring and mitigating that, but that's also a concern that could have while reading the paper. Thank you.
Thank you very much, Mathieu. So unless there are pressing questions, I suggest we move on with the coffee break, and you'll have plenty of time to discuss all the papers you've heard today. So thank you very much for attending this session, and have a good end of the day.